Hey everyone, welcome to the next episode of Genesis Block. Today we're going to be interviewing Carlos Saavedra, who's just an ex Masters in Finance student from the London Business School, and he is working on a DAO Treasury management protocol called Fyde, and has had a very interesting journey in crypto to date. And we connected through the LBS Blockchain Society a couple of weeks ago, and I asked Carlos if he wanted to jump on the pod, talk a little bit about his journey, about Fyde, about the general state of the crypto market, and where he sees it going. So let's jump in. And hey, Carlos, great to have you on the podcast here with us today.
Yeah, appreciate it so much. Yeah, thanks for taking the time to speak with me here.
Cool, awesome. So I think we can just get started. So yeah, do you want to just quickly introduce yourself, your journey into crypto, how you got into it, and just a little bit about yourself and where you see this going?
Yeah, of course. I'm originally from California. My family is from Guatemala, but I'm born and raised in California. Really worked in kind of traditional finance my entire career. Spent some time in investment banking, then was doing portfolio management at Deutsche Bank, doing alternative investments for a number of years. And then I spent some time in venture capital, investing in early stage startups before coming to London Business School to do a master's in finance. But I've been involved in the crypto space effectively my entire career. I first bought Bitcoin back in 2014. And I first learned about it in 2013. And I remember the day very clearly. Like I was studying at my school's library. I think it was like finals periods or something like that. And there was like this business card, and it said like Bitcoin, money of the future. And I just felt, I was like, okay, this is something that's going to be very important. I felt an energy to it. And then I kind of like tucked it away, and like, a little bit after, once I actually had some money from school, I kind of bought Bitcoin. I think my first paycheck, my first job, I bought Bitcoin. And then started trading different altcoins. And over the years, started doing angel investments as well. And then just kind of get progressing. I've been consulting with a few startups, doing advisory as well. But I never really thought I was going to go into blockchain full time. I always thought I was going to stay in the traditional finance route. But when I came to AWS, met some great people that were like, "Hey, I want to start, a company." So we're like, "Okay, let's chat about this. Actually, I have decent experience." So we got together. Eventually, it became Fyde. We kind of were just very active in the crypto scene last year. We helped start the LBS Blockchain Society. I was the first treasurer, and I wrote the white paper for the DAO, which is one of the reasons why we looked into this problem and decided that we needed to solve it, and that there was multiple things wrong, the bigger market opportunity. So we've been doing that for the last couple of months. We finished our pre-seed fundraise about 3 months ago, backed by some good VCs. And now we're just building, hoping that towards the end of the year, we'll launch our alpha product. We already have a few clients on board, but yeah, it's coming along.
Awesome. And if you don't mind me asking, like, who are the VCs that invested, and how did you go about the process of raising from them? Like, what was the pitch like, etc.?
Yeah, that was a very interesting journey, frankly, because we were kind of still like taking some classes and talking to people. And we initially started a little bit before the crypto crash. So we first started introducing the idea, and there was quite a few VCs that were like, "This is the amazing team, amazing market opportunity. You guys should raise more at a higher valuation." So we started getting really excited. And then Terra crashed, and all of a sudden there was funds without money, or funds that just weren't even touching DeFi, or like were returning calls. If they were interested, they were reassessing their whole portfolio. So we went through that. It was an uphill climb. We ended up getting our lead investor, OP Crypto Ventures, kind of right before Celsius crashed, which is very, very fortunate timing. They're based out of New York, a very crypto native firm, awesome group. And then slowly but surely started getting more. We got Arrington VC, who their founder started TechCrunch. Big Brain Holdings, who at one point they're like one of the largest VCs in space. Like I think they were like at 20 billion at one point, just huge. One of these groups that you've never heard of, but like super runs the show basically. There's big PhD Capital. There's Cottigent. And we have a group of awesome angels as well. Founder of Scroll, which is a layer 2. A lot of people from like ex SoftBank people, ex TPS people. So a lot of founders. So yeah, that came along. We still ended up getting oversubscribed, but it was a large process. There was quite a few weeks where it was, giving the same introductory speech every day, like 5 to 10 times a day for like weeks, Monday through Sunday even, or there's quite a few days with time zones that I'd pitch, somebody in Singapore like at 7 a.m. and, pitch someone in United States and California at 10 p.m. the same day.
Yeah, that's exhausting.
So it was a lot. So it got to the point where I was like tired of like introducing myself because all these meetings kind of go the same way. They're like, all right, tell me about yourself. How did you come across the idea? What are you working on? What's the stage of it? Things like that. But yeah, luckily we ended up getting the funding, and I think the most powerful lesson I learned is the importance of like the psychology of investors and fear of missing out, because I think we had spent like 2 months like fundraising and it was like slow, like we had like 2.5 million at that point committed. So we're like, okay, we wanted 3, like we're fine, we'll just stop it here. We have enough to execute the whole project. And so we started telling people, okay, no new conversations, like we need to focus on building and getting clients, and there's a lot of demand for this. That week, after we told people there's no new conversations, we got more funding than we had the entire 2 months beforehand. There was a week where there was like 1 or 2 commitments a day. And I think we ended up being well oversubscribed. But because we had it put like the timeline, people were kind of taking their time. So I think that's very crucial of giving people a reason to like try to hurry and give this a priority. But yeah, it ended up still working out well, and kind of relieved to transition away from fundraising into just building a product here.
Yeah, awesome.
Right. And so, I mean, you're probably going to hate my next question, but so what exactly is Fyde, and how did you decide to start it? I'm guessing you've pitched this, hundreds of times by now, but just for our listeners.
Yeah,
One
okay.
more go. One more go on Groundhog Day.
Just one last time.
I don't mind. It's just when I'm doing it 10 times a day that becomes hard. Yeah, so Fyde started partly, at least personally, was through starting the LBS Blockchain Society, because I was kind of the treasurer of that. And there's DAOs from other university organizations that have hundreds of thousands in assets. Like I think Columbia Blockchain, they did an NFT sale and they raised a couple $100K, and Harvard is like in millions now for their blockchain society DAO. And so I was like, okay, well, LBS for top school, we could easily get to that as well. How do we plan this? How do we manage this correctly? So we kind of started writing the white paper for our DAO and looking into space, doing research, and just noticed that groups like Uniswap, there's all these top DAOs that before the crash, a lot of them had like billions. It's still a fairly large market, but it's down quite a bit. Well, there's all these groups that like all their assets were based on their own token, right? Uniswap has a couple billion in assets still today. It's all Uniswap token. And it's like, as a finance professional, it's like, this makes no sense. You would never run a portfolio like this, much less one that's trying to be more like a endowment type of stuff, right? It's like probably the worst thing to do. So we were like, okay, there must be something here. So we started looking into this. And then we were just kind of iterating different ideas at the time. We were like, there has to be a solution to help these groups get diversification. But why can't they do that? So there's a couple of reasons why they can't just diversify right away. I think one of them that we're solving for is that for a lot of these projects, their tokens come with voting. So when they sell their tokens on the open market for stable coins or for other types of assets, they lose some of the voting control that they have. So they become too decentralized too quick, in that there's outside actors. A lot of them are like bots or malicious and actors that'll accumulate enough of this voting power and kind of monopolize the protocol in the DAO. So there's an instances with like ENS, for example, where ENS was trying to do a very good job of decentralizing, where they airdrop tokens to all of the users to kind of have a wide base voting group. But then a lot of these users just sold the token right away. So there was groups that accumulated. There was one group in particular that accumulated enough ENS tokens, and they voted out one of the core founders,
Mm-hmm.
and put themselves in actually. So it was one of these items where like, okay, obviously that's not the right way. These guys actually built really good product and a service. It's very useful, but they got punished for trying to decentralize the right way. And there's been other instances where groups will like make malicious proposals and like drain the treasury. And there's even ways to do it, like they do it more subtly, where they'll put themselves in as a consultant, and they'll slowly accumulate enough votes, and all of a sudden they have this really entrenched power. So it has become very, kind of it starts to become more centralized than you would hope. So that's one of the things that we're trying to solve for in that. Like currently, because groups, they're like scared of losing control of the projects, especially early on, because most DAOs start centralized and then hope to eventually be more decentralized. But when they sell their tokens, they lose their voting power. So we are allowing it, so they're not sacrificing growth. This is one of the things that we're doing. And then the second one is that these DAOs, they sell through automated market makers, right? And there's only so much liquidity in those pools, right? There was a study by Hasu that if Uniswap wanted to sell 2% of their token supply through like 1inch, which is like a market maker aggregator, an optimizer, their token would crash like 80%, I think it was, right? So because they're the large holders, they can't, it's in a liquid asset base. So that's another one of the things that we're solving as well. So those are the two main issues that you have. And we just saw it as incredibly important because I really believe in the future of DAOs, right? In terms of having these organizations that are a lot more flat and a lot more inclusive versus the current corporations that are more top heavy, right? And it promotes social inequality, frankly, when most of the gains go to the top executives, right? So, but by having DAOs, you can really have people that, get real upside in the projects that they're working on, and they can really, align their values with the work that they're doing, right? There's DAOs that are full of art, DAOs that are promoting nonprofits. There's this whole decentralized science movement that's occurring, or regenerative finance as well. So I think if they can solve the treasury issue and actually manage their token in order to use that to pay for operating costs in a sustainable way, and not have the runway all of a sudden evaporate from 1 year to the next, but actually manage themselves into perpetuity, then I think DAOs have the potential to be really amazing. And that's one of the things that we really want to unlock at our company at Fyde.
And so do you think that the DAO treasury issue is linked to a governance issue in general in DAOs? Like, what do you think of the current state of DAOs today, right? Like, where are they in their journey? Obviously, we're just at the very, very earliest stage of the development of decentralized autonomous organizations, where you're really trying to define what each of those terms in individually and in an aggregate mean as well, right? So, and we've seen DAOs have a lot of governance issues up to date. Like, for example, the one token, one vote model might not really be fit for purpose for every single DAO, right? And obviously, the way that the governance is linked to the treasury is through how that treasury and how the governance tokens and governance power is distributed to participants or contributors to the DAO. So where do you think we are in our journey with DAOs today? What do you see as some of the biggest problems, just maybe in terms of governance, but also treasury management?
Yeah, I think DAOs are still incredibly early in their journey, which is why it's so fascinating to be involved in the space. There's so much experimentation going on, and every DAO you look at, they all run pretty differently, right? So there's a lot of different variation to it, and it's still so early. There was a study produced by Boston Consulting Group and the World Economic Forum. It was the end of last year, but they said that last year, at the end of last year, like there was only like a million people that were members of DAOs in some way, right? Much less than that, people actually getting paid by DAOs. I think maybe like 5% of those are actually working full time for DAOs, right? So it's still very early. I think their treasuries had reached about 20 billion, which was growing at a rate of like 40x, I believe. Incredibly, that's very new. But they were projected that by the end of the decade, those treasuries would reach a trillion, right? So it's this huge exponential growth. And so, who knows how many people will be active in DAOs or members of DAOs at that point, right? I think it'll be very widespread, hopefully. So I think it's really interesting to see, how it's shaping. But yeah, it does have a lot of issues now, as like any early stage technology, right? Some people describe it as like even before email was out in the internet. Some people say even earlier, frankly, with like MS-DOS and those kind of things, because it can be quite difficult, right? So there's quite a few issues still in that they're not as decentralized as they want to. And if they are like a maker, the politics becomes very hectic. It's too much politics. I'm not a fan of politics, but it's one of those things where if you do become a delegate, you do have to kind of jockey for position in terms of getting your thoughts out there. If you do want to kind of lead the direction of the DAO, you have to kind of get a little band of people that support you, and it becomes a lot of work. And there's a lot of different issues without much potential payoff, at least in the short term. And I think there's just not enough tooling. There's a lot of companies that are creating tooling that are maybe like dashboards or things for like processing payments. But there's more and more kind of different projects coming along that are, I think, going to be kind of significantly important. Just over the last couple of months, there's been quite a few new innovations with like bonding curves and incentive mechanisms to incentivize capital and liquidity to flow in different directions at certain times. And I think that'll be important just for price performance, which is important for incentives and to motivate people. And I think once you can figure that out, you can figure out things like governance, because people just will spend more time and be more active contributors. But yeah, it's one of those things where I'll look up and I could spend a lot of time on one particular DAO, getting caught up on their history of it, and then there'll be another one that's completely different. They might have a completely opposite stance of how they manage voting and price performance. So it's a really fascinating field, frankly. There's just so much variability, which is why I'm so happy that the society is the delegate now for Aave and for Maker. And I think that'll be a really fascinating learning experience for the students here. I'm jealous. I put the groundwork, but I wasn't able to participate in it. But I think
No,
that'll
it's
be
super
very,
interesting.
yeah. I mean, what are your thoughts
Right.
on the Aave so far? Are you guys participating yet?
Yeah. So we've done quite a few votes now. I think we've done like 5 or 6, and we've, there's some pretty critical topics in there. I think that was the first one that I looked at was was around the decision to onboard Chaos Labs, which is a risk and simulation platform onto Aave, and Gauntlet already provides similar services to Aave. So there was a bit of let's say back and forth in the comments between Gauntlet and some contributors and Chaos Labs as well, and it led to the them changing the terms of their proposal in term giving it for providing the services for free for the first 6 months, and using it as a testing base. Then so it was pretty interesting just to see like the dynamics of that community discussion. But I feel like yeah, it was super interesting. I feel like there was like already there are a couple of things that I've noticed that could be done a little bit better, which is like for example, you've got snapshot for polling, where you go on snapshot and you can you can easily just well, not super easily, but you can configure a bot, and that can email you every time there's a proposal starting or ended, because it's it's not as easy to keep track of like a web page that gets updated all the time. But then we realized that there was actually an Aave governance dashboard as well, that where the executive voting happened, and that was the voting after the Aave's after the snapshot polls. And I mean, to date, we haven't figured out how to get automated notifications for when a poll starts or ends on that, or is posted, all of those kinds of things. So there's just just a little bit of friction in the experience, but overall the content has been super interesting. Ended up creating a delegate platform, started posting our rationales on that. So yeah, like I've really enjoyed the process of participating in the Aave governance, and from what I see from the guys who are taking up Maker, there's a lot more complexity when it comes to Maker, and their governance is extremely, it's just like a bit of a beast to unravel. And there's always like constant polls and votes and all those kinds of things. So actually, like, that's a pretty good segue into my next question, right? So in terms of the scalability of a DAO, like how quickly it can move, how quickly it can react to situations, um, i- i- I think that there's a bit of a push and pull between sufficient between decentralization and centralizing, and pockets of centralization, essentially. And I think that it's important for there to be a bit of a balance between those two. And I'm not sure if you've read Vitalik's post. I don't know. He posted it a few weeks ago around DAO governance and which aspects of DAOs he thinks should be decentralized, and some aspects that may need to be centralized in order to enable scalability. So on this, sliding scale of sufficient decentralization, what do you think your position is? Where do you think there's a balance that needs to be achieved? What's your opinion on how DAOs can scale and operate as efficiently as current corporations do?
Yeah, I mean it's a tricky question. But Vitalik had another really good post a while back on the meaning of decentralization, right? I guess most people just don't really have the right definition of it, in his opinion. Because there's like the network centralization in terms of the blockchain, for example. There's also like political power, right? And is that decentralized versus not? And I think there's a couple other spectrums that he talked about. But yeah, a lot of the political power right now is really not decentralized. And there's a lot of conflicting levels of interest. Like you mentioned Gauntlet before, right? So if Gauntlet they probably own tokens, right, of certain groups, but then they're also providing services to that group. So they're probably getting paid in the token. So they're kind of accumulating more political power, which in traditional markets, you would not be able to do that. You would have to disclose that, hey, you're both an owner, but then you're also trying to push these like different proposals through. Just going to have clear conflict of interest. And there's groups like, I'm sure Gauntlet is there's Gauntlet, Llama DAO, and like Index Co-op does that a lot. And they get very cozy, and then all of a sudden they're like, hey, I think with Aave, they're delegates for like Aave, right? And one of the reasons they got that from Balancer was that they would just help Balancer with quite a few items. Balancer doesn't want to sell their own token. They haven't found the right product for that, but they had Aave tokens through partnerships. So because Llama DAO did a lot of help for them, did a lot of work for them for basically very cheap, they delegated these to Aave. And Llama DAO was always like, yeah, we'll never, vote for ourselves. We'll always be independent. But it's like, hey, then how come every time you post at the end, we're like, yeah, Llama DAO would be interested in helping, right? And it's one of these things. Okay, you already have voting power, and your majority have good ownership in voting. Obviously, you're going to dictate the decision-making process here towards your self-interest. It's just natural human tendency, right? So the fact that it's not really disclosed is kind of a problem. So I think it's just a power dynamic, right? If you're a founder, not all of them would want to decentralize, right? It means you have less ownership control, right? If you're a VC, why would you want to give a lot of these up, right? A lot of these tokens or these voting up as well. You could do that, some of that as terms of marketing incentive, but there has to be return. You wouldn't just do it just to have a decentralized environment for the sake of it, right? There has to be pros and cons to it. So I think there's a kind of a spectrum of growth that I think DAOs are trying to figure out. Because early on, you have to start centralized as the core team. Otherwise, it's just like pure anarchy, right? It's like there's no direction. But then the question is like, how do you become decentralized? How do you bring people in? Do you do like ENS where you airdrop in, all of a sudden you're fully decentralized, or do you try to do it over time slowly? I think it has to be slowly because you have to iterate at your business, right? And because of that, there has to be certain checks and balances. So at Fyde, for example, we want to become a DAO as well over time, and I'm thinking about different ways that we're going to structure that because we're managing different people's assets, right? So one of the things that we're doing is we're thinking about having like a hybrid model where there's part delegations, parts democracy, where certain people get delegated, kind of like they make a DAO to have more direct control over the strategies implemented in our portfolio. Well, it'll be a small group, and it'll be one that'll will need to be the people will need to be qualified, right? It's not just pure voting. It's not just pure like, hey, I was able to lobby and some random person made it. It's more about hopefully meritocracy. But then there'll be other elements where the general community can participate in, right? Be it with research or scouting, new tokens to include into our pool, things like that. I don't know if that'll work out in the right way that we envision it to. But we'll also have some backstops in case. I think one thing Curve DAO does, for example, is that if there's a hack or if somehow the code's not working the right way, they have a core executive committee that has like like an eject button basically, and so they can kind of reverse or stop certain projects from taking over their funds on an emergency basis. So I think that's necessary. I'm sure a lot of projects are like that as well. So it's one of these things as well where I think there's once you start peeking behind the curtain, it's not as decentralized as you would think, right? You mentioned with Snapshot, for example, most votes on Snapshot are off chain. So it's more just like public sentiment. And then there's like a follow-on vote with like the actual holders of the keys and they push it forward, right? So there's been instances where like the community vote one way, and then if it's some legal reason or something happens where it shouldn't be pushed off chain, it doesn't, right? So it's I think Snapshot is trying to come out with what they call Snapshot X, where the voting poll automatically gets pushed on chain, so it doesn't break, and there's no way for a founder or a VC to overrule it later down the line, which happens, frankly. Yeah, it's still not quite there, frankly. So I think that's why the formation of DAOs has slowed down quite a bit recently. And the ones that are already established are just trying to iterate to find the right solution for the different problems that they come across. Well, yeah, we'll see what the next year happens with these different groups and how that develops. I don't have the answer to that, frankly. It's a difficult problem.
Yeah,
Right.
definitely.
So if I could just like summarize, so there's two different problems that DAOs see today, right? One is on the financial side where their treasuries are not diversified because it's, the money is raised using the native token itself. And because they have just accumulated so much of only the native token in their treasury, every time they want to diversify, they have to sell their native token, and that automatically leads to lots of selling pressure on the token. And it also sends a kind of sentiment to the rest of the token holders that the founders or the team is selling their tokens, and that automatically increases negative sentiment more. So that's one aspect of it where DAOs need to diversify, but it's tough for them too because they don't have enough liquidity of their own tokens. The other problem is the governance problem where either, there's too much decentralization where voters are kind of fatigued and, there's constant votes happening and there's just not enough participation. And it also leads to another problem where a few parties, accumulate a lot of voting power and then kind of take over the DAO and the decision making themselves. So my question to you is, what is a better solution going forward for the governance aspect? Do you have, sub DAOs that, are delegated different tasks that they need to do? And is a hierarchical structure like a normal company the best way forward, but still making sure that it's decentralized enough as compared to, a centralized entity that's completely controlled from the top down?
Yeah, I mean, I think it's a balance between growing and decentralizing, right? And it's almost like because the token the price is linked to the voting, you kind of have to sacrifice one or the other, right? Because as any company, any startup, right, you want to have some core decision makers so you can move agilely, right? Because once you become more decentralized, then it's a lot of politics involved and it's slower. And there's situations where you need to move fast, you need to iterate, and it's hard, right? And it's hard to align those incentives because you're not necessarily paying someone a full-time staff with upside, right? You end up having these like different part-time people or consultants within DAO structures. So we believe that breaking the links to those is the right way to do it. That's why you do see a lot of different projects that have, their voting escrow type of token, this VE token, which is like the early iteration of trying to do that. So effectively having like a almost like a derivative of the initial token that it only counts for votes. But one of the things that does is that then the VE and like Curve or Balancer, people will rent it out or they'll sell it, frankly. And it still doesn't really solve the voting problem. But I think it's a good attempt to it, because then you could take your initial token and you can use it for lending, or you can do different financial activities with it. So I think it's a step in the right direction. It's kind of what we're doing. For us, when a project, let's say if they decide to use us, they will deposit some of their native treasury into our pool, which will be composed of a lot of different tokens in there. And then they will get back the Fyde treasury token. So the Fyde treasury token would represent the essentially the returns of the underlying basket. But what we're also doing is that on our website, we're going to allow people the choice to retain governance or not. So if you're voting, if you're a founder and you do want to retain governance for votes, you can check a box. And once you get the Fyde treasury token back, we'll essentially tag your wallet. And when you go to our site, it'll be very similar to Snapshot. You'll see the proposals you're eligible for, right? So now you can vote on the same proposals. But if you decide to sell the Fyde treasury token, right, or your exposure isn't necessarily tied to the proposals of that project necessarily, right? There's less correlation. Because that's one of the issues now that's happening, where when the market crashes and you want to pay for expenditures as your protocol, you have to sell more and more of your tokens. So you get like this debt spiral, right? And that's the whole thing we're trying to break. I think unless you break that, DAOs just won't survive. Governance won't matter, anything won't matter. You have to break this negative pricing cycle. So that's what we're doing now, where like you can use the Fyde token as a way to get liquidity, to pay for developers and balancing people without crashing your own native token price. So that when the market does crash or your own token price does crash, these aren't necessarily happening both at the same time. They can probably happen independently for different reasons, right? So it just makes it so your project is more likely to not die, which happens quite a bit now. But by allowing groups to retain their governance, they then don't have to sacrifice voting when they go to liquidate and fund their expenditures, right? Because if they sell the Fyde treasury token, their own native token votes get put into like a reserve pool, so they don't actually exit the open market, not to the extent that they would so on an open market sale at least, right? So it kind of slows down the rate of decentralization, and it allows for founders to better control their growth trajectory, both from a actual asset base perspective, but also from a decentralization base. So just kind of a different toggles that allow for a project to grow the way that they want to, right? Because that's different for a lot of different groups. So it's all about giving them control end of the day and providing flexibility.
So what is the basket of assets that the Fyde treasury token is composed of?
Yeah, there'll be, we have selection criteria that we're building in to have the right tokens. So a big chunk of these would be like Ethereum, stablecoin, rep Bitcoin, for example, right? Very liquid assets that, if you sell those, you don't necessarily have a price impact for the most part, right? Because the markets are very deep. And then there'll also be some larger cap projects as well. These are like the Maker or the Aave that we might just buy on the open market for at least in the beginning until we can establish a relationship. But there's also medium and smaller size groups, right? That have good projects with good revenue streams. Maybe some of them don't even have a token, and they kind of deposit some of their fundraise stable coins, and then as a way for them to get some of the upside that they need to have their runway really extend, right, and have their project have a better chance of surviving. There's quite a few startups that will raise for 3 years. You only really need 2. So what they're planning on doing is maybe putting in 3 months of runway into our project, because they'll have the higher Sharpe ratio. And then if the market does go up, right, all of a sudden they have 5 years of revenue or 6 years of 6 years of runway. So there'll be all these different types of companies that they become complementary, right? Because the bigger projects, what they want is a higher Sharpe ratio, because they want to maximize their portfolio. But in order to do that, they need to buy into smaller cap tokens, because smaller cap tokens tend to have higher growth potential. The smaller cap tokens, what they need is liquidity. They have a liquidity and yield. They have a hard time actually, their market's not as deep. There's not as much liquidity in like Uniswap pools, for example. But one of the things that we're using is that, for example, this is a concept in traditional finance. If you look at a municipal bond ETF, the underlying bonds are very illiquid. They're very rarely do they trade. But when you put it in this wrapper, the wrapper itself becomes very liquid. So we're using that same concept here as well, in that we're having the wrapper be the very liquid instrument, so that all of a sudden the sum of the parts, all the liquidity of the tokens within our pool adds up more than what it is individually. So that's one of the things that we're offering and we're doing here, and we're doing quite a few of putting together risk metrics in order to ensure that only the right projects enter the pool. Like most other index type of products do like market cap and liquidity filters. We're also running quite a few like network analysis to gauge to see if groups are decentralized or not, or if there's like wash trading happening, or if there's like a key wallet risk that might be able to rug pull certain projects. And it'll also be able to tell us if groups are lying, right? Because if a project's like, yeah, we're very decentralized and very liquid, and then we look and say, oh, you're actually not, or you're not growing in the right direction, right? Then that might be a project where it's like, okay, we don't trust these founders. We can't let them in. And we're also looking to partner with quite a few other service providers that are doing really interesting things. Building data pipelines is a really good business model that's very needed at the moment in crypto. There's groups that, for example, are measuring GitHubs, and like, hey, are those being improved upon? What's the quality of the code base? Does it match the white paper? And that they'll give you like a score, or they'll give you like a set of metrics on that, or like what does Discord community look like, right? There's Discord communities that are very low quality, but people just want to pump their own projects and they just want price performance. Those communities leave very quickly when the market crashes. But there's other communities that are very, very good, that are talking about productive items to grow the project. So they'll help this startup that we're talking to. They have a risk measure on that. So there's different things that are happening. There's credit scores in crypto. So we're building out a data architecture, so we can take in as much of this data, put our own spin to it, to have our own proprietary portfolio management process here. So we can run a systematic algorithm to ensure that our whole goal is we want to have as low volatility as possible, so that we can adopt like an endowment style approach into the crypto space for these treasuries that we're managing.
That's super interesting. I think that yeah, it's pretty comprehensive. And just one question in addition to that would be, obviously this is a very volatile space, and you're kind of the tokens obviously composed of a bunch of crypto assets, right? So so obviously if they're trying to increase their runway in one way, they're also not trying to reduce their runway in the other way. And is there any backstop that the tokens have, or like, for example, if a DAO decides to deposit into the pool, and they say, okay, we simply cannot afford a loss more than X%. Is there any sort of backstop that that's been implemented, or that you guys are thinking of in terms of reducing or limiting downside?
Yeah, there's definitely a few things. So cryptos are very correlated, but what we're looking at is more of a beta approach, right? Which takes into account correlation, but then also the magnitude of volatility. And I think with that, according to our analysis, you can control for a beta target. So we want to be kind of a fraction of the beta of the overall market, so that if the market is down 80%, we'll be down 40%, right? So then at least because for a lot of these projects, what's most important for them is to stay above their operating hurdle, because they have this strict expense rate, and if they drop below that, they have to fire people. They just can't get to their next stage of cycle. So for these groups, they're like, it doesn't really matter if they're at $1 billion treasury one day, if next year they're at 10 million, right? It becomes hard to do project planning. They would rather be at $1 billion one day and then maybe not get as much upside, but you're only falling down to $500 million, right? That just the endowment style approach. It just means you'll last into perpetuity, which I think that's what we're doing. The way that we're getting there as well is that there are starting to be more of different types of assets that are in crypto, right? There's like gold-backed assets. We're in conversations with a group that does that, essentially gold token. And there's real estate projects coming out, and there's there's just different types of projects that are coming out that are going to be less correlated. Even DeFi versus metaverse, they move at different times and different rates, right? So by having the right balance there, I think will be important. And I think the other thing that's really interesting that we're doing are the bonding curves. So these are essentially incentive mechanisms to have liquidity flow in our direction during the time that we need it, right? So Olympus did this very well in that they sold their own token at a discount in order for people to bond with them or to deposit their token into them. So there's some things here that we're still working on that I want to share too much, but effectively we'll like give incentives out to act as that backstop, right? So if
just the protocol control liquidity essentially.
Yeah, owning your liquidity. We're looking to a couple different ways to do that. So that's one, and that'll ensure that these liquidity pool positions don't get disbanded. It's one of the reasons why when the market crashes, that prices crash. In that, right now, if let's say LBS is a token, and Yasha's like, I want to make a market for LBS token, and you happen to have some, and then you put in the LBS token with like Ethereum into Uniswap at a certain range, and all of a sudden you're giving liquidity for it becomes a liquid token. But when the market starts falling and the prices start changing, you suffer impairment loss. So you obviously don't want to do that. So what you'll do is you'll dissolve your position before that happens. But then there's less liquidity in these market makers, so it becomes harder to transact. The bid-ask spreads become higher. Right? So if I want to sell, I got to sell for a lower price. But what Olympus pioneered, and what a lot of different groups are doing now, which is becoming the standard, is this liquidity pool bonding curve, where I'll go to Yash and say, okay, instead of dissolving, I'll give you some sort of incentive, some sort of token as a bonus. Just sell me your liquidity pool position. And now my own protocol owns my own liquidity pool positions. So I'm not going to sell those because I'm on my own project. So it's like a permanent state of liquidity, so that now it becomes so that bid-ask spreads stay pretty tight at all points of the cycle. So that's one of the things.
So you're ensuring liquidity for your token yourself, essentially.
We're ensuring, yeah. So that's one of the backstops we're doing. Where like now a project, if they're like the market's crashing, I need my runway, you could just sell the Fyde token to whomever, like for USDC or ETH, and because we're going to own our own liquidity, that'll be a very smooth process, right? For other projects that don't own their liquidity, all of a sudden you're getting 50 cents on the dollar, and it just becomes unsustainable, right? So we have quite a few bonding curves that we're looking to implement so that our risk parameters stay in check, our liquidity pools stay in check, so we can incentivize people to participate in this and really create a new financial product where people help us manage the portfolio alongside us. So we're really excited to kind of share that when we're ready to do it later this year.
Cool. Right. So if I could again just summarize so that I understand it better. So you are helping with both aspects that we spoke about, the diversification and liquidity problem and the governance problem. The diversification problem you're solving with your Fyde token, which is essentially an index fund that y'all are overseeing and ensuring that the assets in your index fund or your pools are the correct assets to specifically reduce the beta of the DAO's treasury if they were to raise money using your token, right? And that will also ensure that they have better liquidity because they don't need to use their own native token. They can use the Fyde token, which is backed by a bunch of different index assets. So it's already a diversified token in a way. And you all are making that liquidity sticky for your token using bonding curves to ensure that you all own your own liquidity so that in times of contagion or market pressure or a downturn, the liquidity doesn't leave the Fyde token ecosystem or the Fyde DAO. It stays with y'all and y'all own it. So there's that backstop that y'all are creating, ensuring that even in a market downturn, the Fyde token will retain its value, and that helps DAO treasuries because usually during a market downturn, their governance tokens, they fall maybe 80%, 90%. Now, because you all have increased or you all have decreased the beta, the token will hopefully not fall as much as it would have in a normal scenario, if that's correct.
Yeah. Yeah. So we're not trying to control for the price, right? We're trying to make sure that the value of the underlying assets stay pegged to the price. So the NAV has to equal the price. So that's what we're controlling for here, because we can't really control what the market does. But we do believe that once projects start using and kind of become our clients, that they'll become this like positive selection effect, right? Their own token now will perform better because there'll be less sell pressure on that token, right? They can use the Fyde token to pay for balances and expenditures. So then there's kind of less supply for their own token, and it kind of increases in price. So then the value of the Fyde assets kind of go up overall. So what we're saying is we're solving for the 4 pillars of blockchain treasury management, which all need to come together holistically. Diversification is a big one. Liquidity of being able to sell a token to use your assets is another one. We're also providing yield, in that the assets in our pool will be able to stake them and yield farm and get more cash flow into them as well, which is really the key if you want to run a pension fund, right? You need this current income. And then the 4th is the governance, right? Where we allow groups to retain their own governance. And I think we see multiple instances where 1 or 2 problems break and they'll work interrelated. So I think unless you can solve all 4, it won't be as efficient as a solution. And I think this really encapsulates everything that a DAO treasury needs, and it'll solve the majority of the problems the majority of the time. And I think after we've launched this kind of first strategy, then the goal is to have different satellite portfolios. So we'll have different kind of more bespoke strategies, because different DAOs have different needs, right? Some of them might need more yield. Some of them might want to be more beta neutral, right? Or might want to take on a bunch of risk, or upside. So we'll be able to do stuff like that, right? Option strategy, right? Some sort of yield farming strategy. We're doing a lot of MEV strategies internally. So it might be one exclusively to that, for example, like with flash loans. So I think there's a couple of things we can do that then we can advise these different treasuries and say, okay, based on your current needs, this is the composition that you might want to consider for your asset base. So yeah, so it's kind of progressing, but we want to launch this first strategy first, make sure it works.
Yeah, I think that one of the more interesting aspects of what you touched upon was also the compensation part of it, because DAOs have struggled a lot with understanding how to appropriately compensate their contributors in tokens that don't, become worthless overnight, basically. And yeah, so you're, and if I'm getting you right, you're essentially proposing that the Fyde treasury token should be used to compensate DAO contributors as well, just because it's got aspects of the original the DAO's token in it, but also is a basket of assets that won't face theoretically, well, not even theoretically, it won't face as much volatility as an individual token might, and also has a backstop of liquidity against it, which means that it makes more sense as a compensation token. The product market fit is correct, essentially.
Yeah, because a lot of these, if you're like a bounty hunter or like an auditor, you just, once you get like the object token, you just sell it on the spot.
Yeah.
Right. So then it's like it just crashes the price. So a lot of these DAOs, they're pausing a lot of that activity, which is a shame, because it's not as inclusive to like new members. And it's hard for them to like give stable coins, which is the preferred for a lot of these different outside groups, because like I said, it's hard for these DAOs to diversify their treasuries into stable coins. So now with us, they could sell the Fyde, use the Fyde treasury token for those kind of activities, because we don't mind if someone sells it, because we have processes around that. But then the DAO can save their own token to only the members of the community that are actually heavily involved and are aligned with the activities, the activities, right? And not just someone that's going to be there for one project and then be gone forever.
And what are the strategies that you've got in terms of like the Fyde treasury token being sold? What is it that you do to dampen the effect of that?
Yeah, I mean, so we're borrowing a lot from traditional finance. So it's kind of like an ETF type of structure where there's a redemption process, right? So you'll always be able to redeem the assets back. So we're looking at quite a bit of natural arbitrage cycles to ensure that there's different market participants incentivized for a little bit of yield to make sure that there's this liquidity and there's the peg stays, right? And it happens in the ETFs as well, where when the NAV and the price does break, like an investment bank will redeem the ETF, get back usually some sort of duration match basket of the underlying. They'll sell that on the open market and they'll use it to buy more of the ETF, right? At like a fixed,
Just to get the arbitrage back.
Risk-free arbitrage, right? And that's why for a lot of these ETFs, their price and the NAV stays really well aligned for the most part. So we're borrowing some of those same principles here as well, and
Cool.
improving upon them with what Web3 can do.
Cool, that's very interesting.
Right.
And yeah, sorry, this last question from me, in terms of Fyde and the characteristics. So we've both seen that era, that Gauntlet release era, the yesterday or day before yesterday it was, which is their treasury management solution protocol. So we were wondering, in your opinion, what are the main differences between what Fyde is trying to do and what Gauntlet is trying to do? It's a very long white paper, so I haven't had time to go through the entire thing. But like in a summary, what would you say the main differences are? And like, do you consider them as competitors? Like, would you be willing to collaborate with them in some way, shape, or form?
Yeah, I mean, I think we see ourselves as more complementary, right? It's a big space, and there'll be a lot of different groups that coexist over time. So we're actually, obviously they're a big group, but it also kind of validates that this is a pressing need as well, and this is a potential different solution that we have for the same item, with kind of a different type of experience and different team that we can bring to the table. So there's a few things that we're doing differently, right? We're very focused on kind of governance and reducing governance attacks, which era they don't really do that or touch upon that, right? When a DAO deposits their tokens, they kind of lose governance rights off the bat. So that's one of the things that we're looking to solve. The other is the liquidity, right? In that for us, we'll have the Fyde token that a project can like instantly mark itself, and for the most part, get the liquidity it needs. Whereas it seems like Era, it'll be like a vault, so that'll be locked up, and it'll be more sticky, right? It won't be, if you deposit $1 million, you might have liquidity of a fraction of that, right? Versus with us, you'll get full liquidity because it'll be the Fyde treasury token. So I think those are the two major components. I think diversification, we'll wait and see how it develops for those guys, because it's really like a ETH peg to the native token. And I guess they're trying to incentivize arbitrageurs to sell bits of the native token for other types of assets to get some diversification. So we'll see if it actually dampens the pricing pressure that I described earlier when there's like sell orders for a particular type of token. If it'll do that effectively. We're acting like reserve. So I think for us, we're definitely certain that'll break it. And it also seems like for the era, that'll really only be useful for really large treasuries that maybe are using it as a kind of like an insurance pool, like an Aave, for example. Whereas for us, like smaller projects of all shapes and sizes can use our product. There's no minimum. Because Era, I think what they're doing is kind of structuring kind of call options. But in order to do that, you need a very liquid kind of large treasury in order to achieve that type of scale and have that be efficient. But for us, we're not really doing that. So I see these as different projects, solving different things kind of in different ways. So yeah, it's interesting to kind of read through what they're doing. But yeah, there's different projects out there. We're all doing it slightly differently. We're hoping to be the one that's more kind of autonomous, systematic, and more kind of financially driven. Our team has experience working on Wall Street for many years now. We're not just people that came up in tech that are trying to figure out finance, right? We're a team of accountants, portfolio managers, etc., CFAs. So it's one of these items where I hope using the traditional finance tools that have worked for decades, and borrowing what works and improving upon it with blockchain. Hopefully that's what will differentiate us over the long term.
You're right.
Perfect.
So one last question for me, I guess, because this, the token and platform you all are building is kind of so robust in different ways. Do you think, you all can in the future target groups other than DAOs, because the index management and the risk management platform that you all are building is not really prevalent yet in crypto. There's still lots and lots of risk and not enough wealth management solutions out there. So do you think you all could become a broader wealth management solution for crypto as compared to just helping out DAO treasuries in the future? And is that part of your roadmap? Have you all discussed it?
Yeah, that's definitely part of our roadmap for sure. There's a lot of different client bases that we're looking to integrate with, right? Yeah, we definitely want to be like a vehicle that scales for these family offices, hedge funds, and different investors with like liquid funds, because a lot of these groups, they can't really access smaller cap tokens because they all of a sudden own too much of it and they move the price of it as well. But because we're doing this within this wrapper format, now all of a sudden, these large investors, institutional investors can invest at scale, right? And get access to a different segment of the market that previously wasn't really as available to them. So we definitely are it's in our roadmap to try to reach some institutional adoption at some point. We're working a lot on kind of the regulatory front, how to have the right custodies in place. So I think we still need a little bit of work to do on that end, but it is definitely in our sights for sure. There's other groups as well across the ecosystem that have these same issues as DAOs. Protocols do, miners do as well. Foundations have the same issue. So I think we have a solution here that really can appeal to quite a few people. And there's all these different types of companies that have come to us say, yeah, what you have is interesting. And sometimes it's for different reasons, right? But the fact that we can package them together, and if someone's more focused on governance and someone's more focused on diversification, they can kind of help each other out there within our vehicle. I think it just shows that we provided something that's very, holistic and well-rounded, and hopefully it will work for long term.
Perfect. I think yeah, that's a really good ending point for the podcast. So yeah, thanks so much, Carlos, for joining us today and speaking about your experience in crypto, speaking about Fyde, and yeah, I think I can speak for both Yash and I when I say that we're super excited to see what you guys come up with, and the product and the team and everything look super interesting and very robust, and you've thought about a lot of different angles when it comes to managing DAO treasuries and the whole governance aspect of it as well. So yeah, thanks for taking the time and hopping on and talking to us today.
Yeah, I really appreciate it. Thanks a lot. It's a great thing what you guys are doing here to spread the word about blockchain to LBS and to overall the community.
Perfect. Thanks so much.
Thanks
and
a lot,
yeah,
Carlos.
see you later.
All right,
Thanks
appreciate
to
it.
our viewers as well.
Yeah, thanks a lot, guys.
See you guys next time.